It's Happy Valentine's Day. I got a nice little card from my wife this morning. I got a nice little heart full of chocolates. She knows how to get my heart. My wife believes that the 5 love language guy is completely wrong. She believes that there's 6 love languages, and that 6th love language has to do with food. So,
How do I get it?
and that's definitely
Louder.
possibly my wife's love language is food. If she's ornery, I know I just got to give her some food and she's happy. Happy Valentine's Day to everybody out there. I did not even realize this was Valentine's Day for this call until this morning. And I was like, oh, it's Valentine's Day. But I'm like, maybe they'll give us a better call. Maybe some people stay home from work that day. I don't know. Maybe people make more time. I see a lot of couples together. Wow, this is like, we're going to have like a kissing contest or something this morning. But anyways, thank you guys for being on. I'm excited about today's call. I am going to share my screen real quick here and kind of get going. We normally like to start a couple minutes after the top of the hour, just to kind of give people a opportunity to hop on. I see a lot of people that I know. I see a lot of people that I think maybe have already invested with Dave, so I'm excited about that as well. And I've gotten a lot of people ask me about the ATM machines. It's quite funny because that was something that we did ourselves. Can you guys all see my screen? The welcome there.
Okay. I can see you.
Awesome. Okay.
So,
I'm excited. If you guys can just start by muting your sound there, we'll get started here. Welcome. Happy Valentine's Day. I already said that, but I'm really excited about today's call. As you guys know, I've been in real estate, done real estate investments now for about 20 years. And just the last, I don't know, 5-6 years, starting to look at some other alternative investments outside of real estate. And a lot of them have a real estate component to them, or they have some kind of a business component, which I'm actually probably a little bit more passionate about business than I am about real estate. So this is kind of one of those things that kind of attracted me to Dave. Plus, as you guys know, I'm a Christian. Dave's a Christian. I love bringing on those people that have like-mindedness and that really do want to build our kingdom here, but also want to build God's kingdom. And I'm happy to have people like him on and people like we had on last month. So Dave's going to be on today. Welcome, Dave. I know you're already on the call there. Thanks for being on today. And last
me, Tom.
Yes, last month, if you guys didn't watch or you guys weren't here live, make sure you go back and watch. You guys can go to our website. Ann Kelly probably did one of the best jobs I've ever seen of somebody explaining the economy, explaining real estate cycles, explaining the economic cycles, and kind of how and why. And one of the things that she mentioned is something that I was mentioning a year ago, which is what she was doing is just same thing a lot of us were doing, is starting to hoard cash, maybe taking some chips off the table for a certain period of time, and making sure that we have, sound financial, cash. And because during bad times, people don't normally go under because they're over leveraged, which is kind of a myth that's out there. A lot of people say that they really go under because they don't have enough cash. And that being cash strong, I think, is super important. But she did a super great job. And if you guys haven't watched it, go back and watch that. I do want to promote some events that we have coming up. And I've got some people on this call, but I'm just gonna promote them for them. First of all, if you guys aren't signed up yet for Jim Ingersoll's Deal Maker and Mastermind, I guess he started adding this and Mastermind. Me and Wendy Sweet has started doing these Mastermind sessions on the last day for Jim, and I'm excited about this. You guys can go to, I'm not sure if it's dealmaker.com, but if you guys just look up Jim Ingersoll, if you guys don't know him or not in his Facebook group, which has almost 250,000 people in it, I would highly recommend that and get on those groups and come to this event. Also, just got off a cruise with the Investor Addicts. So if you're like some of us and if you are addicted to real estate, right, Tom Nardone, then next year we already have, Tom's already got next year's event up. So February 11 through 9 will be on 11 through 18. Sorry, we will be on the Wonder. I think right now it's the largest ship in the seas, but I think by next year the Icon might pass them. But we had a great time last week. I just got back Saturday night from being on this Investor Addicts cruise, got to meet a bunch of new people, and we had a great time on that. If you guys are interested in that, there is an early bird special. I think it's $250 for the seminar itself. After March 1st, it's going to be $299. And I don't understand what the outside booking means, but if somebody books outside of this, it's going to be $399 for that as well. So obviously you got to pay for the cruise. This is the dollar amount here is just for the actual seminar, but this is a steal. If you ask me, for a whole week, to be kind of locked on a ship with a bunch of other investors. It's really cool to be able to kind of get those one-on-one conversations and those dinner conversations and really kind of get to know each other. I've been on at least, I think, 8 or 9 cruises in the last 12 years. It started out as the IRA Fund Cruise with Quest IRA at the time. Now it's Quest Trust Company, putting those on. And then it went through Financial Friends, and now we're kind of Investor Addicts, and we've kind of added some new people to the group, and it's really interesting. Also, Tom Nardone also has an event I'll be speaking at here in June, June 21st, 22nd, 23rd, 24th, in Punta Gorda. Went to this last year. It was such a beautiful place. This is where the seminar is going to be held. So if you guys want to enjoy the water, we do go on a nice cruise little thing at night, one night, and have a good time. But it's really a great meeting. He's got some good speakers that are going to be speaking at this year's event, and love to have you guys out there. He sent me these slides, so I'm going to assume that this price is good because he sent me the slides. So Tom, sorry if you didn't mean to give everybody a $600 discount, but I guess for this call, it's $397 out there. So Tom sent me the slides. It's his fault. So we get a $600 discount if you guys sign up for this, but sign up for it soon because he will book. Last year he had over 120 people, and I think put it together in about 3 days or 3 months, I should say. But I'd highly recommend that. ThomasNardone.com, and if you use the promo code $600 off, that's for that. If you guys are interested in the cruise with Tom, just maybe go to the same website, or you can just text me 219-742-7957. And if Amelia, if you could put some of this in the chat, the ThomasNardone.com, that'd be great. I don't know if he gave me slides on.
Hey, Tom, I'm sorry to interrupt, but to sign up for the cruise, the website has been updated. They can sign up for 2024. It's simply investораddicts.com.
There you go. So Amelia, can you just put investораddicts.com in the chat there so people can go to there. So since last month, I'd like to kind of talk about this. I just told you guys, we just went on the Investor Addicts cruise. We had a great time. This is a picture from most of the people that were on there. We did really have a good time. Me and my wife got to enjoy this. This was Coco Cay, Royals Island there. We had a good time. And then also one of the funnest times of the cruise for me is we have a charity that we supported, and we raised $42,000 for Share the Love. So they supplied wheelchairs to the one, I forgot what number, 100 million people or something in the world or something, they said, that need a wheelchair, that live in third world countries that can't afford it. And it was a good meeting, had a good time, and I was glad to be able to support Augie in that Share the Love thing as well. Upcoming, I do want to remind everybody, I'm sponsoring, and I'm still trying to raise a little bit of money. I appreciate you guys from the last call. So the last call, I mentioned this. This picture that you're seeing right now was last year's senior trip at Hammond Baptist, which is the school that my kids go to. And every year for their senior trip lately, and hopefully for the foreseeable future, they're going to be taking their kids on a missions trip, which is going to be kind of half fun. It is still their senior trip, and then half missions type of work. I believe all kids should go on a missions trip at some point in time in their life. And I'm try to put my money where my mouth is. I'm also going with the kids this year, and we'll plan on going the next 2 years because my kids will be actually seniors the next 2 years as well. But between last call and this call, I raised $2,000 from people on this call. So that was honestly, I was kind of blown away. I appreciate that. I've only got $4,000 more to raise to be able to hit our goal on this. Now the kids still have to pay $1,000. The kids are still, they're not going for free. This is still, pretty expensive trip for them as well. But just if anybody's interested in sponsoring that and helping out with that, it is a tax deductible write-off. It is a 501c3, the high school. Just get with me, and I can definitely help you with that. I got a check in the mail this morning that I need to bring, and I can help you make sure that you get that letter of donation from that as well. And I've got a match on the table. So I mentioned this briefly in my presentation on the boat. And Quincy Long, one of my mentors, somebody that I've looked up to for many, many years, came up to me and said, "Hey, I'll match the next $1,000 of donations that you get for those kids to go on their senior trip." So I'm going to throw that out there to you guys. So I don't need one person to give $1,000, but if 5 of you guys could give $200, or maybe 10 of you guys could give $100, Quincy Long is willing to match that money, and I would appreciate it as well. If you guys want the tax write-off, like I said, I can definitely help you get that letter for that as well. So got to meet with Quincy, and Quincy's doing great. If you guys know Quincy, he's got Parkinson's disease, but he had a surgery recently, and he's doing so much better. Got to sit with him in dinner one night, and I just love this guy. If you guys don't have that book, Self-Directed IRA Secrets Revealed, I promise you, it is literally like the textbook for IRA investing. And I'm proud of this book as well, because my words are actually written in this book before Quincy. So I am the very first person that got to give a review of the book. And I'm proud to be that. So love Quincy to death, and glad that to see he's doing better. Do want to remind everybody about our event, September 7 through 9 coming up. goodsuccess.com/free-for-all. We do have a great VIP package this year, which includes all the videos and all 3 books that I've written. And we just have a great time. It's for fun. It's for building community. It's for doing deals. It's for learning. And we don't really claim to do a whole bunch of else, but that's it. Like if you're needing community, if you're trying to find lenders, if you're trying to find people that you can loan money to, if you're trying to find deals, we had a great meeting last year, and I'm super excited already about some of the sponsors and some of the speakers that are speaking this year. Do want to remind everybody about the videos from last year. We kind of got a late start on getting these out. So if you guys are interested in getting the videos from last year, you guys can also find those on our website. And then the next call we have scheduled, I think some of you on this call probably know Miss Mary Hart, but I've got Mary Hart, who just did an absolute amazing presentation at Mr. Landlord. And I said, I've got to get you on here. And she's going to talk about what real legacy is at first. I asked her to do two parts of her thing next month. And part of it is like what real legacy is, which is what I like to talk about. It's the carrying on legacy. It's living your legacy today. It's not just passing on the money. I think a lot of people, when they think about legacy, they only want to talk about passing on the money. Yes, that's important, but I feel like there's another part of that that's way more important. And she's going to tell a story about her father-in-law, or her stepdad, I think it is. And I'm super excited about that. And then I told her to also kind of give us some tips and things about how to pass on the money, and one of the things that we need to do for estate planning. She's one of the best I know. Many of you guys know her, and you guys will not want to miss that thing next time. So remember, everybody, be a conduit, not a bucket. If you guys are interested in our fund or anything we can help you with as a borrower or as an investor, please let us know. And then we'll give the floor to Dave. Welcome to the call. Thank you so much for investing in our community. I'm excited about the call. I will stop sharing my screen, Dave, and be quiet and let you have the floor, sir.
All right. Thank you. Thanks, guys.
One thing I wanted to mention, I talked to Dave at the beginning this morning, and he would really like to make this as interactive as possible. So if you guys have questions, like just throw them right up in the chat right away. I'll try to interrupt Dave if you're okay with that, and we'll just make this as interactive as possible. Dave's just an easygoing guy. He's not gonna bore you with a bunch of flash or anything. He's just the type of dude that I would want to invest in. It's interesting. I will tell you this, and I won't tell you who the other party was, but when I first started getting into investing in these extra alternative investments like ATM machines, I had a choice between ATM machines and another product that is similar to ATM machines, but not ATM machines. And the other similar product showed me I would get a better return. it showed me the long-term numbers, all the things in your head that you tell yourself, all the numbers, the return, the yield was better if I would have went in the other direction. But I sat down and I looked at this and I said, okay, what are my priorities when it comes to doing investing? And my number one priority is return of capital. And I believe that should be your number one return, your number one priority as well. And so I chose to work with Dave and his ATM fund solely because of that, because I believed in Dave and I believe that I had a higher probability of getting my money back if I worked with Dave, somebody that I trust and I've known for many years and seen lots of investors get paid back, rather than this other company that and now it's kind of funny because we are having some problem. I did not invest in that other deal, but there have been some problems with that other one, and I haven't had a single problem with this ATM fund. So I'm sorry, Dave, I kind of let you start and then kind of took it away from you, but did want to give that out there before you got started.
No, thanks for that, Tom. Thanks for your partnership over the years. We've enjoyed doing business with you. And thanks to everyone on the call. I gave Tom the full permission to talk over me, to interrupt me, to argue with me, to whatever he wants. And to you guys as well, feel free, if you have a question, feel free to drop it in the chat box. If it's something that's relevant to what I'm talking about at the time, Tom, just grab the question, throw it at me, and question or comment, throw it at me. And I'm looking forward. I would love for this to be interactive with you, Tom, and your group. So thanks for having me. Thanks to everyone who showed up. Looks like we got a nice crowd. I recognize quite a few of the names, but for those of you who I don't recognize yet, thanks for showing up here as well. Happy Valentine's Day. Like Tom said, I felt like I should have gone back and tweaked my slides a little bit and made it for like, investing as couples, or how do you save taxes as, as couples and all that, but it's a little late for that. So I guess I won't go there. So I built this business. I was an investor long before I built the Real Asset Investor and built the team, and really, just for a little context around, some people ask me, what do you invest in? And I'm like, well, what you see, what I send out to my investors is just a direct reflection of my personal portfolio. That's what I invest in. We have a couple core asset classes, which we'll talk about a little bit later, but our core asset classes are self-storage, car washes, and ATM machines. And then we have some other funds, like last couple of years we had natural gas. I'm a big fan of natural gas. Long-term bullish on energy. So but what some of the things that we're going to talk about today is just the things that I'm familiar with and that I really like, and for some very specific reasons. So this quote is one that I actually had trademarked, and I'm sure I don't have to explain it to any one of you. I'm sure you will identify and agree with me, but you can be conventional, and I truly believe this. You can be conventional or you can be wealthy. Pick one, and you could really put in, you could really change that wealthy word out for several different words. One could be successful. I really believe to be wealthy has more to do with other stuff than it has to do with money. To be, you can be rich, but if you don't have your health or you don't have any relationships, I don't know that you're really wealthy. And I think many of you would agree with us. So, whether that's conventional in terms of money, in terms of health, in terms of fitness, in terms of, education, whatever that is, I just believe you have to take a non-conventional approach to life in general. So I don't know how many of you know my story, but I had built several different businesses, and I was in a position where I was in a position where I was a tax slave. Built these businesses, started paying $500,000 a year in tax, got tired of it, and really got to the point where I was like, there's got to be a better way. And I heard Robert Kiyosaki. I remember him making this statement. I started, reading and studying and doing a deep dive. He said, you can make millions of dollars a year and pay no tax. That drove me crazy because that wasn't me. And I had no idea how to get there. And I just, from the time I was a kid, I just thought, I was taught to believe that conventional wisdom, you make a lot of money, you pay a lot of tax. It's just how it works. Well, I hunted this guy down, and I went on one of those real estate guys cruises that Tom was just talking about. And I went for the sole reason to get around this guy and learn what, I figured the biggest shortcut I could take is get around him and learn about what he's talking about. Like, what do you mean you can make millions of dollars a year and pay no tax? Another thing that changed my life was, another quote that changed my life was, if you want to change your tax, you got to change your facts. And it was the first time in my life that I realized that, okay, I'm in control of my own destiny. I don't have to be a victim of the system. I realized then that I was being taxed because of the way that I was behaving. And if I changed my behavior, I would change the way that I would get treated and the way the IRS would treat me. So let's talk about real estate. What's going on with real estate? You can see this all over anybody that knows anything about investing in real estate knows that, interest rates, what's happened to interest rates in the last year? They went up by a lot. Does that mean that you shouldn't invest? Does that mean that, those opportunities that were there a year ago aren't there today? I would say not really. And, one of the things that I would want to make clear today, it doesn't matter if interest rates are 5%, if interest rates are 10%, or if they're 50%. The deal has to work. So the deal can work at any interest rate. You as a smart investor, you got to figure out, does this deal work? Does this deal work for me? My dad will tell you about times when he was first getting into business, first buying his business, when interest rates were in the 20s, in the low 20s. Well, we went from 3 to 6.5 or 7. And we think, wow, that's terrible. It's not terrible. It's just you reset the way that you change up the way that you do business. You change up the way you look at deals. You change up whether that is to take out an interest rate on or an interest a finance package on a deal, or whether you pay for it in cash, whether that is a vehicle. I remember the lowest interest rate that I paid for a vehicle was like 1.9% or something like that. Today, if that interest rate goes to 12%, would I still finance it? It depends. But, I always look at, okay, what's the interest rate? What's the inflation rate? And if the government tells me that the inflation rate is 8%, well, number one, I don't believe them. I have my own theory on what the interest rate is. What the inflation rate is, and I sort of have this range in my mind where I believe the interest rates are. I just keep jumping back and forth the interest rates because I'm looking at it on the screen. But the inflation rate, so I sort of have this range in my mind where the inflation rate is. But if the interest rate is lower than the inflation rate, that means that you're net positive. Like when you take out a loan, that means that you're actually getting paid to use the money. If you can loan money at 6% and the inflation rate is at 8%, that means you're getting paid 2% to take the money, right? So just train your mind to think about that when you think about interest rates and the cost of capital. What does it cost you not to take the money? And then it's your job as a smart investor to go out there and find an asset class or an investment that can give you a good rate of return with that money. So another thing that's going on with real estate today, I think buyers and sellers have different expectations. I think sellers were used to being, they were used to controlling the table. They were used to setting the terms. They got used to a certain kind of market. I think, they're having a reality check right now. In the long term, the buyer is going to win. In the long term, the buyers always win. There will be a reset, there will be a shuffle, and I'm not talking about the reset that you would hear from the World Economic Forum. I'm just talking about expectation reset. There's going to be a time, there's always cycles like this. There's always times when, you as an employer have, have the kind of the control of the table where there's more employees than you need. And then there's other times when the employees have their seat at the table and so this stuff goes in cycles, whether it's buying assets, whether you're a buyer or a seller. There's sometimes when you want to be a buyer, there's other times when you want to be a seller. But in any market, there's opportunities for you as a buyer, there's opportunities for you as a seller. But there will be a reset on the expectation from buyers and sellers. In the end, a buyer is going to win, because smart investors will not overpay. Now, this is, I'm talking in the short term now, they will pay or overpay for some assets. But as those interest rates adjust, as the inflation rate, what's going on in the overall economic system, as those things change, the buyers and sellers and asset price and all those things change. I'm having quite a few conversations, and you can imagine I'm involved in several different asset classes, like Tom mentioned. All of those asset classes, we're having these conversations about. I just had a conversation the other day about large tracts of land. Some of we've purchased around 30,000 acres of large tracts of land over the last 2 years. I'm talking to these guys. I'm talking to our self-storage acquisition teams. I'm talking to the guys out on the street making acquisitions in the car wash space. But I'm talking about holders of assets that have leverage on those assets that have a rate lock, and the rate lock is at a much better rate today than when their rate lock expires. So there are assets that may work very well at a 3.5% to 4% interest rate, may not work so well at 6.5%. So some of those 5-year rate locks are going to be coming due, here in the short term and over the next year or two. So if there's not a decline, if interest rates continue to climb or even stay current with what they are today, you're going to see some buying opportunity. You're going to see some buying opportunity from those types of situations where the owner of that asset is facing a different reality than they were 2 years ago. So what does that look like? I think that looks like opportunity. It looks like opportunity for asset classes or assets in particular that didn't make sense a year or two ago that may start making sense again in 6 months from now, in 12 months from now. So, it's not a bad thing. I am, Anna last month, she talked about having cash. Not a bad thing to have cash. And I'll give you a little example. There's always this thing like when you have inflation rates at 8 and 9%, the cost of you keeping that money in your account is 8 to 9%. Yeah, if you have an inflation rate of 8 to 9% and you have $1 million in your account or 100 grand in your account, whatever, that purchasing power for that money in your account is going to be worth 8 to 9% less in a year from now. So there's always that thing was like, well, I don't want to be diluted, right? And that's true. You should be thinking about those things, but I don't want you to like live there and think that every dollar that you have at your disposal needs to be in a deal working for you. Sometimes it works well to have cash. I'll give you a quick example. I love to get outdoors. I love to hunt. I love the recreation. We bought a farm about 2 years ago, going on 2 years now, in Eastern Shore, Maryland. Love the farm. We have all kinds of good family time, hunting. It's on the river. Water sports. We love the place. We got the opportunity to buy another farm down there in the area. One of the things that I learned was the seller was very motivated. He got in trouble. He got caught upside down in some development, and he was very motivated to sell. He hated to sell. Owned the farm for like 45 years. This was his legacy asset. This was his crown jewel. Was his farm, and it wasn't fun. I mean, it wasn't fun. And we did not position ourselves as a vulture in this deal, but we did position ourselves like I was in a position where we didn't have to have this farm, but if we could get it for a good price, we were willing to pay for the farm and buy the farm. And so we gave him an aggressive offer. And one of the things that made us very attractive was, one, we could close quickly. Number two, there was no financing contingencies. We made it very easy for the seller to say yes. So we got about a 19% discount on that farm in a bull market. This just happened a couple months ago. So we were still in a bull market, but we got a 19% price reduction off the seller's asking price because we had cash. So if you go into a deal and the more contingencies, the more outs you have in that deal, the less attractive you are as a buyer. If you can show up strong with cash, waive the financing contingencies, and show up really strong and put everything in the seller's favor in terms of you showing up strong, that puts you in a really good position. Many times that'll put you in a really good position. So it's not a bad thing, although there's always that tug of war. You got inflation happening on the one side, and that's diluting you every day that you have money sitting in your account. But there's opportunities that will come your way that you're able to swing a deal, get a discount, get the deal because you show up strong and you've got cash.
Yeah, I'm glad you brought up that example, Dave, because that's the power of having cash during downtime. So like, yes, your money might be losing and you're trying to you're trying to figure out where's that balance. How much do I need to keep in cash? How much do I want to keep in cash for opportunity? But then also at some point you have to start pulling the trigger and start saying, hey, if the deal works, then hey, now it's time to get that capital back out in the street. And that I actually feel like we're already in that. And I mean that I believe that fourth quarter was abysmal, probably one of the worst quarters we have seen on a lot of movement in many. I'm telling you, like, I'm not even sure there was quarters in 2008 that were as bad as what we just saw in quarter four. From just every standpoint, it was just not a great quarter for a lot of different sectors. But we're in that. We're already in that right now. At least that's how I feel. We're already in that time where we should be looking for these opportunities and looking for places to place money as long as it makes sense. But like you said, if your money's losing 9%, but then you can go get a 19% discount. Hey, well, guess what? Now that's where that having that cash and having that opportunity comes together, and it makes sense.
Yeah, I think the key phrase was where Tom mentioned, if the deal works. The deal's got to work. And again, it doesn't matter. The price isn't as important. The interest rate isn't that important. The inflation rate, not that important. The deal itself has to work under those circumstances. Then if you can lock in, that interest rate and make sure you're protected on that side, you can always choose to take that risk if you want. But if you really want to make sure, if you're being conservative and if the deal works, you can lock in your terms, for the short or longer term. If the deal works, you can buy assets in a raging bull market. The deal has to work.
Right. I mean, we're getting a lot of investors that are just staying in cash now. They're like, screw the interest rates. Interest rates don't matter to me. If I'm getting a better deal now and I can pay cash, that's some people's strategy as well. One thing that you mentioned that I did want to pull back out of this conversation you've had so far is if you can borrow at a lower rate than inflation, then you're being paid to take on the debt. And that is one of the things that, Kiyosaki teaches in some of his books. So I thought that was great.
Yeah, thanks, Tom. So let's go to the next slide. We got Anna showed this in terms of real estate. I'm going to show it. I thought it was interesting because I had just saw a very similar slide in terms of the stock market, but it really works the same. It really works the same way. You have the different sort of what's going on emotionally and what's going on, how investors think. This is it. I mean, there's going to be different market cycles in our, if you live for another decade or two, or hopefully 3, 4, or 5, this is something we just need to be aware of. These things are going to happen, but it's important for us to control our emotions, know where we're at in the cycle, and there's different times when you can get into opportunities, and just knowing that, look, we're in a bear market. We're in a nasty bear market. And we're not there right now, but if we get into that position, not even in a bear market in the overall economy, but I'm talking in a bear market in a specific asset class. And it's one of the advantages that I believe that I have compared to some of my peers who are asset class specific. Let's say, many of us know multifamily apartments was sort of the asset class of choice over the last decade. Everybody who was raising money, they were syndicating apartment buildings. And, when I first got into the ATM business and I had an opportunity to take ATMs to my investor group, which at the time was, we were buying multifamily apartments like everybody else. And I was like, well, how's that even possible? Like, how does that work? Like nobody takes ATMs and syndicates them. One of the things that, have to do with this chart and Anna's from last month is, there are cycles, not just general cycles in the overall economy, but if you look at different asset classes, if you look at the time when multifamily apartments were red hot, from whatever 2013, 14, 15 to 2000 to like today, and then you look at what was natural gas doing during that time. You would have been well on the way. During those years, you would have been somewhere on the left side of the chart from, if you were in multifamily, you would have been somewhere in between belief and euphoria. If you were investing in natural gas, you would have been somewhere in between denial and anger. And so I guess my point is there's always opportunity. You don't have to get caught in this thing. Well, okay, we're in a bull market, I'll just sit on my cash. No, there's opportunity in different asset classes that you can take advantage of.
Yeah, it's good.
So I'll give you a quick example. Of that. Let's go back to this slide. I'll give you a quick example of that. And that is, we already talked about natural gas. We talked about how that was in a nasty bear market for most of the last decade. I really got attracted to the space because number one, I generally watch things like that when they're in a when it's a needed commodity, that it's in that space for too long. What happens is there's under investment in the space. It gets a nasty sort of feeling around it by investors, by lenders, by everybody. And so I'm naturally attracted to those things when I see that happening for too long. When you're in that between that anger and depression state, you start to recognize after a while, oh, wait a minute, there could be opportunity here. And if you're interested in learning more about this kind of thing and how to think about some of those things, one of the things that really opened my eyes to this, especially in the commodity space, was probably 10 or 15 years ago. I was reading Jim Rogers' books, and Jim Rogers, one of the first books of his that I read was Hot Commodities, and it talked about the different cycles, specifically in the commodities, and you could take that into real estate and multifamily and self-storage and different assets in real estate. But it talked about how when you get to the point where the commodity is selling at a price less than the cost to produce. Now, if you take that to housing, you were able to buy from 2008 to 2000, what was it, Tom? 2008 to 2012 or 14, you were able to buy houses at less than the cost to produce that house. What was that time span?
Yeah, I would say it's probably 2008 to 2014.
Yeah, so 2008 to 2014, you had this window of opportunity where the asset costs less to purchase than the cost to produce that asset. And you can take that to, we've used this a number of times in our business. Tom, was at our manufacturing facility a few months ago, and one of the things that we buy lots of lumber, and so every once in a while, every couple of years, we get in a position where we get an opportunity. It might happen once or twice in a decade. We get an opportunity to buy lumber, whether it's OSB roof sheeting. We've done it a few times with OSB roof sheeting and some other materials, where we know about what it costs to produce that 4x8 piece of OSB roof sheeting. And every once in a while, you'll have the cost of that asset or that piece of material will dip down below what we know or what we think about the cost is to produce that material. For us, that's like go time. That's like the green light switches on and said, okay, buy. And so there's been times when we've done that where, we've bought so much material. We're like, we can't hardly move around here. So just recognizing this has to do with the stock market, this has to do with real estate, this has to do with multifamily, this has to do with commodities, whatever. But just know that these things are going to happen. And instead of, living in, on the left side of the screen or on the right side of the screen, and just living in that thinking, oh my goodness, well, I guess I just have to wait till the next bull market. No, find something that looks like, find something, a needed commodity, a needed service, a needed something, an asset of some kind that is in either one of those markets, a bear or bull market. There's always opportunity in any market for a smart investor.
Dave, I've actually seen these. I've seen charts like this. I don't have one on me right now, where it kind of even shows in different parts of the cycle where different asset classes always seem to, outperform the other ones. And they're kind of, some of these come early, some of these come late. So you're exactly, I call that inefficient markets. So whenever there's a market that's inefficient, like you talked about oil and gas, like I started talking about 5 years ago with Gary, Indiana, where I could buy a house and fix it for less than $60,000. And there's 80,000 people of population in this city and 500,000 people in this county. And I saw this and I was like, guys, this is completely not right. Like, there's no reason that you should be able to buy a house for 1/2 or 1/3 of what it would cost to build the house. These are all inefficient markets. So, and anytime, and it's interesting because, like what you said, what, multifamily was euphoria for the last decade. There's a lot of people now that are thinking it's peaking, while some people are still buying because they haven't seen that. And a lot of what you're saying rings true to a previous guest that we had, Tom Barry, that was on that said a lot of, what you've been saying, and right now he's buying commercial. He thinks that commercial has gone through this like depression, and then it was like COVID hit, and it just is in this like horrible space right now, and nobody really wants to buy commercial, but that's when those opportunities happen. So don't think that just because what you've always done isn't working doesn't mean there's not something else out there that's just ready to be picked. You've got to have your eyes open and pay attention to those inefficient markets.
So let's do this. I love the interaction, the feedback. I love getting interrupted. I love your comments, Tom. But let's do this. Let's have in the chat box or the Q&A. Let's do it in the chat box. I would love to see. We had. Okay, so I would love to see where you guys think we are on this chart. So if you guys could type in the chat box, where are we on this chart? We're seeing some of those asset prices adjusting already, like Tom mentioned. I mean, we're seeing it in the car wash space. We're able to pick up some lots that some of those prices are cooling off a bit. We're seeing it in the self-storage space where some of those we've had interest rate hikes, and some of those deals don't perform nearly as well. Well, all of those deals don't perform as well when you have an interest rate hike. So we've been negotiating those prices. But I'd be interested in seeing where you guys think we are in this market. So if you could pop that in the chat box, that would be great. Let me see here. Josh says depends on asset, and absolutely 100% right. Let's do since this is a real estate panel, let's talk about real estate, and let's talk about real estate, multifamily, and self-storage. So if you guys can pop in the chat box, we'd love to hear what you guys think about where we are. Asset and geography, that's right, Josh, couldn't agree more. Lila says, think we're between complacency and anxiety. Yeah, anxiety, complacency, I'm seeing a lot of that. Yeah, between euphoria and good stuff. Yeah, no, this is good. Okay, let's go to the next slide here. We got a lot to cover in a short time. So we
got to get to those asset classes that you do. So just make sure we get to the ATM machines, and that's what most people are on here for.
Got it. So what asset class? You could say, okay, what asset class is hot? Where is the value in this market? How do I find value in a bull market? And so sometimes you have to create value. And I think in the last couple years, in the last 2 years, 4 years, the best way to go out and find value was to buy an asset and force the value, create the value. I'll give you a couple of examples of that. When we buy, even today, we're okay paying, buying. Let me go back here. We're okay buying a self-storage facility at a 4 cap. And you might say, well, wait a minute. How can a smart investor pay a 4 cap for 3.5 to 4.5 cap for a self-storage facility? There's no meat on the bone at that point. So that is where the value creation, that is where we step in and say, okay, how can we create value? If that 60,000 square foot self-storage facility is in a market that is underserved for self-storage, you got population growth, you got job growth, you got a lot of good stuff going on in that market. If I can turn that 60,000 square foot facility into 90,000 square foot and add 20, 30,000, 40,000 square feet of climate controlled units to that building, for those of you who are not familiar with what we do in the self-storage space, our business model is we buy from a mom and pop operator. Oftentimes they're a single asset owner. And this is, by the way, this is for you guys who are not familiar with this space. This is a very fragmented asset class. This is, you got a lot of mom and pop owners. So again, you got inefficiencies in this market. So what we'll do is we'll go in and force the value. I'll give you another example. We had at one point, starting in about 2012, I started building a position in multifamily apartments. We built our portfolio up to between 3,000 and 4,000 doors. And so there was talk about creating value. Not only were we fixing up the apartments and getting them stabilized and all that, but we were there was specific properties where we took mobile or modular self-storage units. Some of you know my background is in modular buildings. Our family business is modular buildings. So we would take these modular self-storage buildings into these multifamily apartment complexes, and we were able to charge above market for self-storage. Just think about this for a second. If you're living in a B or C class apartment building and you're having to cross town, drive across town to store your stuff into a self-storage facility, and let's say you were paying $100 a month for that self-storage facility or for that 10 by 10 space. So what happens if you could, instead of hauling your stuff across town and putting it into your self-storage facility that you now rented, you could just walk right out your back door and pay $110, $120 dollars per unit and have your stuff right there on site, your bikes, your stuff right there on site. There is ways that we created value, and the same thing we're doing in the self-storage space, adding climate control units. Our business model is we buy from a mom and pop operator. We destabilize it. We oftentimes we're developing, so we'll build out another 20 to 40,000 square feet and add it to the facility. We then work on our ancillary items. Main goal is to get that NOI up, and then we sell to a REIT. So when you can do that, I can tell you there's a bunch of ways to make money in self-storage. I love the asset class, but there is a lot of margin in that business model. Buy it from a mom and pop in an underserved market, in a vibrant market that's underserved with self-storage. Force value by adding climate controlled square footage. We already know what the REITs will want. We last November, about 14 months ago, we did a roll up. We sold 26 of our self-storage facilities to a REIT out of Chicago. There was a $450 million deal. It netted our investors between 30 and 31% annualized returns. So lots of ways, and this was in a bull market. We started building these positions, in 2017, 2018, all the way into 2019, 20. I mean, this is in a bull market. So, again, we talked about this a little bit ago, like, don't get caught up in this thing where, this is a bull market. I mean, you could have said that in 2017, 2018, or 19, and your position could have been, well, I'm just going to wait till the next crash, or I'm just going to wait till we've got better asset prices. I'm just going to buy gold, or I'm just going to, there is opportunity. You just got to make sure, like Tom said, that the deal works. The deal has to work. Maybe the deal doesn't work. Maybe there's not enough meat on the bone if you buy an asset class at a 4 cap. If that was the end of the story, I would strongly agree with you. But if you buy that and you force value, I think in today's market, you have to be willing to force value, because the days when you can go buy a well-run, stabilized asset and figure on really creating a lot of cash flow for yourself and your investors, there's not a lot of low-hanging fruit out there, I can tell you.
Right.
There's something go ahead. Somebody tried to talk. Was that you, Tom?
I was just saying, right, just agreeing with you.
Okay. So another thing that I want to touch on briefly is I want to shine a light on I don't know how many syndicators do we have in the room? How many people are raising capital? Would love to see that in the chat box. One of the things that I've recognized more recently is if you can be the person, the investor, the syndicator, the people, or the guy who gets creative and puts a deal together, and you can learn how to take a single income asset and create multiple sources of income from that asset. There is, I just talked about self-storage and the margin in self-storage. I would argue there's even more margin here. I'll give you an example. So I mentioned that we bought 30,000 acres in the last 2 years. One of the things that got me really excited about this asset class is we bought a 11,000. Okay, so let me step back for a second. We bought. I mentioned about buying truckloads of OSB sheeting when we're in a bear market and what can happen. So we bought truckloads. We bought like between, I don't know, 50, 60, between 50 and 60 truckloads of OSB. And we actually built a building to house this stuff, thinking that if the price of the OSB goes up by $1.50 per sheet, it'll pay for the entire building. All right. Well, then COVID happened, and now workforce, the workforce in these mills, are affected, and building goes through the roof, and OSB sheeting goes from $6 a sheet to $52 a sheet. And so I kind of trained my mind over the last couple of years to recognize that wherever there's crisis, wherever there's a problem, there's opportunity on the other side of that problem or crisis. And so I started thinking, okay, wait a minute. So if OSB sheeting is now went from $6 a sheet to $52 a sheet, and we use, truckloads a week, where's the opportunity in this? And so we bought 11,000 acres of timber property in about an hour north of Pittsburgh. So what happened when we got into this timber, and there was a couple guys on the team that specialized in different things, and I was able to we were able to kind of pull the talent together and create multiple income streams out of this one asset class. I'll give you an example. The seller was an institutional timber company, and they were being approached. They were selling this piece of property, and they were being approached by a solar company, an institutional size solar developer to develop that part of their property for solar. They had already done all the studies and all the legwork on solar on the property next door. They wanted to expand into this property. Well, the seller, who was single focused and institutional timber harvest, wanted nothing to do with it. They didn't want to encumber the property. They wanted to sell the property. So we buy the property. And from the time we put the property under contract till we ended up actually settling, taking ownership of the property, we had, price of timber went through the roof, and we had more timber on the property than the entire price of the whole package of real estate. Like the timber more than carried the entire package. But then we were contacted by the solar company, and we were able to get a non-refundable hard money deposit for an institutional grade solar company. A solar contract. And the solar revenue per acre in 1 year, it's a 30-year deal, and in 1 year it came just shy of the entire price per acre of the real estate. So you already got timber carrying the property. Now you've got solar all but carrying the property in 1 year, and it's a 30-year deal. And, then we developed some of the property. We subdivided some of the property and started selling smaller pieces of property to other buyers. It's an example of taking a whole pizza for $10, and you got 10 slices, and you're selling the slice at, you're selling the pizza at $2 a slice. So, one of the other strategies we used was to turn this into a turnkey recreational or hunting property. It was a piece of raw ground, raw timber property. We went up there with our big bed machine and we cut trails through the property, and we went in and cut the trees. We already harvested some of the timber. We cut the trees down. We tore stumps out of the ground. We planted food plots. I had a team here. I had some of my team run up and set up hunting blinds and ladder stands, and we turned it into a turnkey hunting property. We've been selling this real estate that we purchased at about $1,120 an acre. We've been selling this real estate to smaller buyers with, let's say, a $30,000 investment into a 100-acre tract, and we've been selling that real estate for $3,500 to $5,000 an acre, $4,800 an acre. I think the last it was, it's incredible when you have the right talent. You can take an asset class with a single source of income, and you can start monetizing these different, start creating different income streams in what was a single source of revenue from that asset class. So just, to get your mind expanded, whether you're doing something in, whether you're an investor in multifamily assets, whether you're an investor in, whatever asset class it is, look for ways to where you can take what is the conventional approach. You got a single source of income coming in. Okay, how can we add income streams to those? Let's say you have a single source, and then you got revenue from the laundromat, or you got revenue from. Let's see how many different income streams you can add to that asset class. And again, it comes down to bringing value, though. If you can bring value out of that asset class, that's what it's about. It's figuring out ways not just to derive or squeeze income out of people. No, it's about adding value to those people to the point where, I mentioned with self-storage, it's like those people wanted to pay me for that. So I was making their life easier, and it was a win for everybody. That's what this is about. Not like trying to squeeze every last bit of juice out of a deal or out of a person. Does that make sense?
Yes, it's awesome.
So
we should all be asking ourselves, how can we sell by the slice instead of how can we sell by the whole pizza? I like it.
Yeah. So, I've had friends in the multifamily space where they were able to buy 2 or 3 assets, together right next door. They were able to add, 100 units to their already 150 unit apartment complex by buying the place next door, and then, taking those efficiencies, management company taking those efficiencies and sort of making it better for everybody. But I've also, talking about selling by the slice, I've also had friends who had a giant, let's say a 500 unit complex, and they were able to sell off 100 units and really, kind of open up that buyer pool. So depending on, and that really depends on who you're trying to target as a buyer. I mean, the last couple of years, if you had a large asset and it was institution worthy, that was your buyer. That's who you wanted to buy from. But there's also times when you can chop it up into small pieces and get better margin from a small piece, because you open up that buyer pool. Not many people could have bought that 11,000 acre tract. There's institutions that could have bought them, but I can tell you, when you chop it up into 150 to 200 to 300 acre tracts, you just expanded that buyer pool by a lot. So be thinking about that. We got to move on.
Yeah, we do, because people are going to want to hear about the stuff that you have to offer.
Okay. Let's skip down to the bottom. I'll touch on the Inflation Reduction Act. By the way, Tim Gertz and I put on a webinar that talked about the Inflation Reduction Act. I sent out a summary that summarizes the Inflation Reduction Act. We really broke down, okay, where is the opportunity? That's a big, ugly bill. It's toxic. It's got a bunch of junk in it, but there's also opportunity in it. It's our job as smart investors and business owners to figure out, okay, where's the opportunity in that bill? The last one that we did, the CARES Act, there was opportunity in that bill. We saved millions of dollars in tax money because we knew what was in the bill, and we figured out how to monetize it. So, if somebody wants a copy of that Inflation Reduction Act webinar, Tom, you can reach out to Tom. You can, or I'll have my email address on the last slide. You can send me an email. I'd be happy to send it to you. We don't have the time to go into it now, so we're gonna go that route. I'll send you the webinar and the summary. So just
Awesome.
Just send me an email. All right. Now we're going to get Tom's been hinting at seeing these asset classes. So here we are. So these are some of the asset classes that I like for a variety of different reasons. Normally, when I look at an asset class, it does one of two or three things. Number one, I got chased into real estate investment because I had a tax problem. I was paying $500,000 of tax a year. I wanted to keep the money that I was earning. For many people, you have different reasons. You have your own reasons. There's many reasons that would have been okay. For me, it was tax, and it still is. I control my own tax liability. I got myself in a position where I make multiples more money than I did back a decade ago. But I pay just a fraction of tax than I used to pay. So I went from paying $500,000 in tax one year to paying more than a decade ago to paying zero the next year. And it all had to do with, again, what Tom Wheelwright said about changing your facts so that I could change my tax. And so when you look at an asset class and you think, okay, what's my return on that investment? Well, many times, depending on what the investment or what the asset class is, and sometimes what your personal situation is, your first year's return may be, your first year's tax savings may be your biggest return. Like when you can save 37% in year one, you'd be hard pressed to find an asset class that gives you a 37% return on investment from the cash flow. If you find one, also send me an email. On that last slide, I'll have my email address in there. Make sure you send me an email if you find one that gives you a 37% cash on cash return the first year. So several of these asset classes, we're one of the top 4 ATM operators in the country. We love ATMs for a number of reasons. Number one, they check my box in depreciation and tax savings. Up until this year, it was 100% bonus depreciation in year one. Now it's 80% bonus depreciation in year one. Still not terrible. But the way that it worked, when you were getting 100% bonus depreciation, I'll back that down to 80% now that that's reality. You're getting most of your principal back through tax savings and the first year's cash flow. In that first year, from the time your cash flow starts, you go out 12 months, you're getting most of your principal back. Or let's put it in other words, you're taking most of your risk capital off the table in year one, and then it's followed by another 6 years of steady income. So we're going to talk a little bit about tax if we have time, because that's one of my favorite subjects, but I save that till last. We'll get into as deep as we want to until Tom cuts me off.
Okay, well, let's just stop right here because this is where you're at.
Sure.
Because I do know for sure the ATMs, the car wash, and the natural gas, those all three of those have a first year major tax savings. And when I was doing this first ATM deal myself, I mean, I basically looked at this at the end of the year and I'm like, either I'm going to write a check to Uncle Sam or I'm going to write a check and leverage. And this was when leveraging ATMs made a lot more sense. They don't make as much sense today like they did 2 years ago. Do they, Dave? They still might, but just not as good a sense as they did back then to leverage. So I'm like, I'm literally going to save the exact same amount of money in tax if I leverage in year one that I'm going to write this check for. So could just explain why that is? Because I think some people understand it, but I don't think, I think if you could just take it a little bit farther on why I don't understand the car wash honestly as much because it's a lot larger dollar amount. It feels like it shouldn't be, it's not personal property. I understand why ATM machines are because it's personal property, but car wash is probably a little bit different. And then also the commodities and natural gas. I'm also in a deal, not with Dave, but another provider in this, carbon credit / commodities, natural gas type of deal. And they're all a little different. Is that right? As far as why you get that tax benefit?
Yeah. So, and to your point about the leverage not making as much sense, the reason it doesn't make as much sense as it did, 2 years ago. Number one, you're, instead of paying 4.5% to 5% for your money,
Right.
Now you're paying, 7.5% to 8% for your cash. So you got the cost of capital. The other thing is, like I mentioned before, it dropped from 100% bonus depreciation in year one to 80% bonus depreciation in year one. And when you could get even just 50% leverage on an ATM, you took your depreciation from, let's say you invest $100,000 and you got $200,000 worth of depreciation. Today that would be $80,000, and add even just 50% leverage to that, you're getting 160% bonus depreciation in year one. So it still makes sense. It just doesn't make as much sense as it did back then because your cost of capital was cheaper and your appreciation first year was higher.
Right. Yep.
So we're not going to get into the details about how each one of these asset classes works unless you ask me the question. But I will tell you this: if anybody's interested in more information in any one of these asset classes, feel free to reach out and we'll send you a report on all of them. As you can imagine, we've got plenty of source data to go behind each one of these asset classes. We'll jump to car washes. What we did is we sort of modeled it after the ATM fund. We knew the ATM fund was very popular with our investors. It worked very well. It got aggressive cash flow. It got depreciation. You talked about depreciation, Tom. One of the things that many people don't realize, and I didn't realize this 3 years ago, and that is there's something unique from a tax perspective that has to do with car washes and gas stations. And those two asset classes exclusively, you can depreciate the building just as if it was a piece of equipment. So no need for cost segregation studies, no need to accelerate depreciation, no need to, you don't get like 3 years in the roof and 5 years in the floor and 7 years in the fixtures, whatever. No, it's 100% what it was. It's 80% bonus depreciation in year one for the equipment, the building, and everything. Now, obviously not the dirt. You can't depreciate the dirt, but everything else is considered. You can depreciate that at the rate that you could an ATM machine or a piece of equipment. So, very, very cash aggressive, very aggressive on the cash flow side. It's also aggressive on the tax side. So again, it checks my boxes. Cash flow and depreciation. I want to make lots of cash flow, but even better, I want to make lots of tax-free cash flow. And so because at some point it doesn't matter, if you make a lot of money or what matters is how much of it do you get to keep. That's the big question. How much of it do you get to keep? Like if you go out and make a private money loan and you're getting 10% interest, and I'm all about making private money loans. I know some of you guys do that, and it's great, but just know that, unless you tie that in with let's say a natural gas investment, or unless you tie that in with something else that will protect you, you're going to pay tax. And let's say you're doing private money loans at 10% interest, you got to pay 40% on that 10%. You're really only making, whatever, 6% interest. And so just know that if you're a hard money lender, private money lender, highly recommend it. It's the easiest way to make money ever, especially, and the most safe way you can make it. When you do a private money loan against a piece of real estate where somebody's going in and adding value to that real estate and you get first lien on it, it's the easiest way to make money ever. Just make sure that you protect yourself, because you've got no protection there unless you combine it with another investment into, say, some stuff over here on the left side of the screen, or some equipment, or, and that's one of the reasons I really like commodities. I think we're in the front end of a commodity super cycle. When you look at natural gas and you realize that they are greatly expanding the capacity to ship international, have been for the last 2 years or more. And then you look at, okay, what's natural gas prices look like where they're shipping it to, and you realize that we're paying somewhere between $3 and $9. If you look at, what it's like in the last month or so and what it was like back in August, we're paying, our spot price for natural gas is between $3 and $9. While in Europe and Asia and Japan, they're paying $35 to $60. And you realize that, the cost to ship is only a tiny fraction of that arbitrage. That to me spells opportunity. And when you can get into that asset class and take a 75 to 80% write-off in year one against ordinary income, that is a way that you could do hard money loans on this side and do a commodity investment or equipment investment, something that will offset the tax liability. And when you can start to invest strategically, using some of these things, using some of these asset classes to offset your tax liability, it's the difference between jumping into the river with a current and swimming upstream. You just got your head down, you're doing your thing, you're doing 15% private money loans, you're making a lot of money. You're swimming upstream because you're not paying attention to the tax side of your business, and you're just making a lot of money. That's you swimming upstream. If you can pair that and invest strategically, it's like the difference of turning around and swimming with the current. So a couple things, and I'll just give you sort of a little bit of a taste of what's in that. I'll give you a little teaser of what's in that Inflation Reduction Act bill. There's a lot of renewable energy in that bill. And so there's $500 billion going to be coming into that space. So it's our job as smart investors, when we see these things developing, that we get in front of that. It's like you on a surfboard and you see a wave forming behind you. And, at the right time, you're getting up on that surfboard and you're getting pushed. And that's what it can look like when you get in front of a wave like that. When you see a wave of cash coming into a space, we're going to have that coming into renewable energies in the next couple of years. There's $500 billion of that money coming your way. And, some of that is going to be my money. Not all of it. I'll save some of it for you guys. But there's some of that $500 billion that I'm going to get. And it's there for you to get. And so just be aware when you're making those decisions, when you're fixing up your buildings, when you're thinking about a solar investment, when you're looking at some of those things, you should be looking at those things differently today than you did last year before the Inflation Reduction Act bill came along. So lots more information. I've got my CPA, Tim Gertz, one of the best CPAs on the planet, is kind of walking through that Inflation Reduction Act bill on that recording. So again, if you want it, feel free to send me an email. My email is going to be on the last slide. Self-storage, I already talked about our business model there. That is an equity play. I talked about 3 different strategies. For me, it's cash flow, it's depreciation, and it's equity. When I'm investing in self-storage, I'm not looking at the cash flow. Yeah, you get 4 to 7% in those early years. Nothing exciting. It's a modest tax play, nothing exciting there, nothing really exciting. What you're really doing is you're investing for the exit. And so it's an equity play. You're building up equity. You realize most of your gains at the exit when you sell to a REIT. So just going through the different asset classes, how I see them, how I use them for myself, and what some of those things of importance are to me: cash flow, depreciation, and equity. And then, last thing on the screen, we had an event here a month or 2 ago where we talked about some asset classes that we like. Again, going back to the Jim Rogers hot commodities. If you believe that Bitcoin is going to be around 2 years from now, 5 years from now, 10 years from now, when do you want to buy the stuff? When it's at $20,000 or when it's at $69,000? I believe, based on what I'm seeing in the background, based on what I'm seeing the institutions do, I'm of the, I trained myself to sort of look behind the curtain. Like when JP Morgan comes out and says that Bitcoin's a fraud, I'm much more interested in what they're doing than what they're saying. It's like a politician. You listen to what they're saying, but then you dig deeper and you see what everybody's doing. Same way here. While he's saying Bitcoin's a fraud and he's saying all kinds of negative things about him, the London JP Morgan office is buying Bitcoin hand over fist. I'm much more interested in what they're doing than what they're saying. I'm interested when I hear Fidelity coming onto the scene and offering it to their clients, or Goldman Sachs setting up trading desks, or JP Morgan getting into the space. I'm watching the institutions. I'm watching the, all of those things, from, number of wallets. That's another one. However you feel about Bitcoin, if you believe that it's going to be around, I would, now may be look. I'm not telling you go buy Bitcoin. I'm not telling you, back up the truck. But if you're going to be buying any asset, look for an opportunity when it has a correction, or whether it's in a bear market like natural gas was for many years. Let's do this, Tom. I know we're getting up close to the cutoff, so you're going to have to tell me when to stop. But I'm going to keep going until you want to turn it over to Q&A. So this is a principle that I believe paying taxes is not patriotic. It's actually the opposite. The government gives you about 5 or 6 or 7 pages of the tax code and tells you what you have to pay tax on. The rest of the tax code, the other 5,700 pages, is telling you ways to not pay tax. And so really the way we look at that is, all we got to do is find out what the government wants, what they want us to build, how they want us to do business, where they want us to invest in, and then we go do it. And they pay us for it. So when you get a big tax bill, it's the government telling you that you behaved in a certain way, so now we're going to punish you. You were a greedy, selfish, all that you thought about was you. You didn't build housing for other people. You didn't employ other people. You didn't add value to a lot of other people. So now, because you didn't behave, we're going to slap a fine on you and we're going to teach you a lesson. So the thought is that when you do what the government wants, they will pay you to do it. So paying taxes is not patriotic. It's actually the opposite. So I would strongly encourage you, if you're looking to build wealth, which I would imagine that's why most of you are on this webinar. That's why I come on to stuff like this, is because I want to build wealth for my family, my community, myself, my my employees, my business, I feel like I can make an impact with my wealth. So manage your tax liability. If your goal is to build wealth, one of the best ways to do it on the front end is manage your tax liability. There are so many different ways you can manage your tax liability. There's so many different ways that the government allows you to do it. You got bonus depreciation, you got cost segregation, you can be a real estate professional and write off, I'm sure Tom's familiar with this one. You can take that, you can take your real estate losses, passive or phantom losses, and offset your ordinary income. You can use captive insurance. We save hundreds of thousands of dollars per year just for having a captive insurance company. Some companies or some people that have a company or a captive insurance, actually the captive insurance costs them money. It saves us hundreds of thousands of dollars per year. You got Section 469, which allows you to take oil and gas investments, offset oil and gas and solar renewable energy, and offset your tax liability on your W-2 or your ordinary income. You got 453A, that's a topic of its own, allows you to defer the tax liability on capital gains for up to 30 years. You got R&D tax credits, some of the most aggressive tax credits that, if you got a business and you don't know if you're eligible, check. I mean, that's some of the most aggressive tax benefits on the planet. So make sure, like some of this stuff, like all of these things, and this is only scraping the tip of the iceberg. Like there's so many different ways you can not pay tax, and the government wants you not to pay tax. You'd be crazy if your tax, if you're being taxed at 37%. So just know that this stuff exists. Know that it's possible. Know that it's possible for you. The big thing about President Trump and his tax, oh man, say the word for me, Tom.
Tax returns?
Tax returns, yeah. The big thing about, I wanted to say it's K1. The big thing about President Trump is, and all the rage about the his tax returns, and then the big thing was like he only paid $700 for on his federal taxes the 1 year, and I was thinking, well, wait a minute. He's a business owner. He develops real estate. He builds real estate. He hires thousands of people. He's got to have a terrible CPA if he paid any tax. But no, people don't get it. But just know that this stuff is available and it's here for you. So we can go as far with this as you want, Tom. I will try to make this simple. You've got really 6 different kinds of income. You got passive income, capital gains income, ordinary income, you got portfolio income, you got short-term and long-term capital gains. And even inside that short and long-term capital gains, mostly on the long-term side, you can be passive or active. You sell a big piece of real estate, most people think, oh yeah, it's 20% tax. Yeah. So then I ask them, well, is that passive or active? What's long-term? Well, okay, but you can have long-term capital gains and be passive. It's important that you know how you're being taxed, because the next one, it's important that you know how you're being taxed, because, well, these are the 3 that are most common. So we'll kind of focus on them: ordinary income, passive income, capital gains income. It's important for you to know how you're being taxed on all of your income. Really, one of the things that I'm aware of this stuff because I'm working on a daily basis, but one of the things that I do in October, November of every year is I go through my CPA, and I'm like, okay, I made, this much income in this bucket, in the ordinary income bucket. I made this much income in the passive income bucket. I made this much income in the capital gains bucket. So now what have I got to do? How do I protect myself? Uh-oh. There's supposed to be one more slide in there. It doesn't matter. I'll walk you through it. So how do I protect myself from that? I will take a certain asset class that aligns with that stream of income. I will invest in that asset class, aligning with that stream of income to make that stream of income tax-free. It's that simple. It's not complicated. You're not shielding money offshore, and you're not creating complicated trusts that are expensive and confusing, and you're not trying to, fool anybody. It's really that simple, and anybody can do it. So I am about out of time, so I'm gonna do this. I'm just going to encourage all of you guys to build your wealth, but build it tax-free. There is a way you can do this. Robert Kiyosaki was right. I'm a living testimony of that. You can make millions of dollars a year and pay no tax legally. This is not rocket science. It's not super easy, but it's not out of your reach either. It's not hard to do, but it's easier not to do it, right? So I've been telling you about this slide for the last 15 minutes. So there it is. If you want the Inflation Reduction Act, if you want a copy of this presentation, if you want to reach out to my team, any one of those asset classes that I talked about, you can feel free to do so. And my team and I, we are here to help. We love Tom and what he's about. And I'm grateful for the opportunity to come hang out with you guys for a little bit. So Tom, back to you. I'm happy to stick around as long as it takes to answer questions, comments, whatever.
I appreciate you staying on. I appreciate you investing in our community here. There's a couple questions that didn't get answered. You might have answered some of this already. And I feel like you kind of did, but there may be some explanation you can give here. So it says, besides 1031 exchange and oil and gas working interest, what are your best ways to defer taxes capital gains?
So capital gains, let's say you are a real estate professional and you sell an apartment building and you make $100,000 profit. That is capital gains taxed at 15 or 20%. Most likely for people that own big multifamily apartment buildings, it'll be 20%. But it doesn't stop there. Since you were active in that business, that means you're going to get taxed 20%. And the only way to offset the tax liability, the only way to offset that 20% is to use another asset class. You could buy another apartment building and use that depreciation to offset tax liability that you just experienced. Or you can invest in some other asset class that gives you the depreciation or IDCs to write off active income, ordinary income. So it's very important to understand what bucket does that income flow into. Are you a passive investor and you just sold that asset and you got 100 grand? How are you going to get taxed on that? You're going to get taxed 20% as an active ordinary income or passive income. So it doesn't stop with, is it capital gains? There's two different ways you can get taxed inside of capital gains. Just know what that is for you. And then to protect yourself from that, you could either, buy other assets that give you passive losses, or you could buy oil and gas or renewables or something like that will give you protection against ordinary income.
That's good. I've got one more question. If you guys have any more questions, just post them here in the chat, and we'll just get through a couple more. I do have one here that I think Layla is her name, is asking, are you going to have a commodities fund in the near future?
So we had, I started investing. The answer is yes. So I started investing in natural gas almost 5 years ago. And the reason I started investing in natural gas was I was involved in an RV park that we put together close to a natural gas port, where they were spending billions of dollars expanding and enlarging this port to where they could ship natural gas overseas. So that's when I got to take a closer look, and I was like, oh, wait, what's going on here? This might be an opportunity, because I quickly recognized that we were getting between, at the time, between $1 and $2 for our gas. In Asia and Europe and Japan, where we were shipping the gas to, they were getting, $30 to $60. Their spot price was $30 to $60. So that's when I started investing in natural gas. Now, I was a year and a half early. It was much fun at first, but it came around. And in August of this year, we were selling $9 gas. So I was an investor personally for almost 5 years now. And 2 years ago, we put a fund together. Last year, we had a fund, and we expect to have another fund open in Q2 of this year.
Excellent. I did want to, if you don't mind, go back to the slides that have the different asset classes that you have on there. And I did want to just let everybody know that he does have open slots, I think, in at least I know you have 8 slots open in the ATM machines for credit. I think, are these all accredited investors? We can start there.
It is, and we have a fund open right now for ATMs, car washes, and self-storage.
Okay.
We're expecting to have a natural gas fund open in Q2.
Right. So when you guys email Dave, if you're interested in those, and if you're an accredited investor, if you want to get the PPMs on those, obviously ask him and he can get his team on that. He sends out a great email that really does a good job explaining it to you enough where you feel like you kind of understand what's going on with it, to, whether or not you want to pull the trigger or not. And his team's always good at getting back with you on questions or whatever that you've got for that. So now, like I said, the ATM machines and the car washes do have a year 1 pretty good extra tax benefit. I don't believe that the self-storage does. But like Dave said, he's investing in the self-storage fund for equity. One question I wanted to follow up with here is, so you did explain, like, you're doing certain ones of these investments to basically zero out other income you're having in the same type of income, right? I mean, so, but maybe just give a little bit of direction. I know a lot of people that are on this have a lot of self-directed money as well. Some of it's Roth, some of it's not. And obviously that kind of goes into play. I invested personally into the car wash fund in my Roth before you offered this depreciation deal, because I felt that the returns were good enough even without that. So maybe just kind of give, your outlook. If you have self-directed money, if you have traditional self-directed money versus Roth self-directed money, and then if you have cash, or any other kind of ways to be able to invest, where would you invest your money?
Yeah, so very good point. One of the things that we do is we don't only just fund deals, we educate, and my goal is to get my investors tax efficient and be smart with how they allocate different dollars to different asset classes. And I'll give you an example. So if let's say you've got 100 grand and you want to invest, let's say you got 100 grand, let's say you got 200 grand, and you're saying, well, I want to invest 100 grand out of my IRA and I want to invest 100 grand in cash. And you're number one, you got to be comfortable with the asset class first. You got to like the asset class. But if the asset classes check out, then I would say, okay, put your 100 grand into ATMs cash, and put your self-directed IRA money or your Roth money into self-storage. The reason for that is, our track record would suggest that you're going to have a juicy exit on our self-storage fund. When you do, that's protected inside your Roth, and you don't get taxed on that. When you invest IRA money into ATMs, it's not okay. Let me back up a second. When you invest cash into self-storage or multifamily apartments, and you have an exit 5 or 10 years later, you've taken all of that depreciation, and that has worked for you over those 5-10 years. When you sell that asset for a profit, hopefully, you not only get taxed on the profit, you get to recapture all that depreciation and bring that back, and you get taxed on that too. Okay, so that's one reason why it would make more sense to potentially use an asset like that in your IRA. When you invest that 100 grand into ATMs or car wash, you never recapture that. So if you don't take advantage of that with cash, you're leaving that margin on the table. Like if you come into car washes or ATMs with your self-directed IRA, it's not bad. You're still getting a double-digit return, but you're leaving a couple points of margin on the table, because it's not something where you're going to recapture that in 5 to 10 years. That's something where if you don't take advantage of that, that's going to go away and it's going to die, because you don't have to recapture that.
No, that's a good point. It kind of goes along with the question that David has here. When you get depreciation on equipment such as ATMs, is there depreciation recapture later at some point, similar to when you sell a rental property? And so let me just maybe, take this a little step farther. So, basically you're getting 175% of your money back on the ATM machines and the car wash. And depending on how, now the car wash could come early, ATMs, like you're keeping those for the long haul. But I guess the question I have is, all the money you get back then is taxed. So kind of like getting all your principal back and getting 75% return, you're not getting just taxed on the 75% extra that you're making. You are getting taxed on the full 175% of, what you invested, correct?
Well, it depends. Okay, so if you take, so I'll give you an example. If you invest 100 grand in the ATMs and you take that bonus depreciation up front, year one, you use that bonus depreciation to offset tax liability on some other thing that you've got going on that year, then you would be correct. If you take a more conservative approach and you just take the depreciation and sit it in your depreciation bucket and you do nothing, then that depreciation will make most of your cash flow coming from the ATMs tax-free. So you get the first, let's say, 4 years of cash flow coming from your ATM investment in tax-free cash. So to your point, yes, if you use all of that depreciation in the first year for something else, then you're going to get taxed on the 175 that you get back.
Right. No, I thought that was the answer, but I just wanted to make, pretty much sure. So I guess Kevin is actually on here, and I believe he actually did this on your car wash. So the car wash is also a potential play, which I don't think Dave's going to get into here. But if you guys want to go back and listen to Kevin Femley's call that we had, he talked about how he used, I think, this exact car wash fund to buy in his traditional IRA, get it appraised a little bit after the fact. And because you don't have control, because it's a time period of time where it's unknown, you can get this appraised by real appraisers that will appraise, how much that's worth. And Kevin's worked out, a lot of other people that I know have worked out where you can then convert those traditional IRA monies and convert that into a Roth, and then be able to pay less tax on that conversion. So if you don't understand that, please go back and watch Kevin's. We don't have time to get into that today because it's kind of complicated, but I'm actually eyeing this car wash fund myself as a potential future Roth conversion. Me and my wife cannot have solo 401ks. We have too many employees, but we've got SEPs, and now they're offering Roth SEPs. So be able to convert our traditional SEPs into Roth SEPs, that car wash could be a play for that as well. And if you guys want to talk offline on that, I'm more than happy to help you. Or Kevin is actually another good resource for that as well. So Dave, thank you so much for investing in our community. The last two speakers I had on here were just really big givers. We're like 44 minutes over what we kind of say. We say it's going to go for an hour to an hour and a half, but we're already 15 minutes past that. But I love spending time with Dave. I do think that he's a lot smarter than I am, as you guys can see. I wrote down 3 pages of notes myself personally. And just, one of the things that really stuck out to me is it's our job as investors to figure it out. It's our job to not just rely on everybody else. It's not and let everybody else tell us what to do. Although it's great to have people like Dave that has dug into this tax code, but it is our job to, and I also love what you said about watching people are doing not what they're saying. Do you guys realize, as much as we hate Joe Biden, and I'm probably not in the Joe Biden camp, just so you guys know, I'm not in Joe Biden camp, but he's done more to help the commodities than any other president recently. Like watch what he's doing when it comes to natural gas, not what he's saying. He's saying we're going to get rid of all natural gas, right? But at the same time, what's actually happening in reality is we're exporting more than we may have ever exported. Where do you think Germany is getting all their natural gas from right now, folks?
One more thing, Tom. I just read a report, and this has been going on in California and New York, and I was getting some feedback from investors like, well, wait a minute, isn't this going to drive the price of natural gas down? That was on the news that any new buildings built in New York or California could no longer be natural gas heated. You couldn't have your natural gas pipes running into the building. So this was supposed to be all like clean and we're going to do, but when you take a step back and you realize, okay, where does the electricity come from to heat the building? Well, it comes from coal or natural gas, right?
Or nuclear.
And the same way with, this whole thing about, electric cars, you're going to have, it's going to be so much cleaner. There's no fossil fuels now. You got electric cars. Really? You know where your electric's coming from? It's coming from coal and natural gas. Yep. And so, yeah, to your point, I mean, I just read a report again in Oregon from this morning. There was a city in Oregon, I forget which one, but there was a city in Oregon that just, they just climbed on that bandwagon. No more natural gas in our home. Well, really doesn't matter, because your electric's your base load power is still going to be natural gas or coal.
Yep. We live in weird times, that's for sure. So just real quick, if you want to throw that last slide back up, if you guys did not get Dave's email address, he is offering to be able to send these slides to you. And also just ask him about the other things, the other investments, if you guys are interested in any one of those other possible investments. He does have an open fund right now in the ATM machines, in the self-storage, and in the Tommy's Car Wash. And if nothing else, the Tommy's Car Wash is just cool. If you guys haven't been to one, I would suggest you find one in your local area. They're not all over the country. There's a very segmented, asset class, like he said. But if you guys do have one in your local market, I would suggest just go by. It's a pretty cool little experience, and I think you'll see very quickly how it's adding up and how they're doing so well on that. And I'm excited about that, being with them with that. Thank you again.
One other thing that I'll mention, Tom, and that is, yeah, it is our job as investors to figure it out and dig into this stuff. But I will tell you that don't get lost in the weeds. Don't try to figure it all out on your own. It's okay to be the generalist. You can have, Tom's talking about Roth IRAs and self-directed IRAs. I know just enough to be dangerous in that space. I don't use IRAs, I don't use Roth IRAs, but I know enough about it that if I wanted to go down that path, what I would do is I would find the best IRA guy in the business and I would go do something with him. One of the things that I believe has served me well over the last couple of decades is that I know enough about a specific topic, just enough that I know, okay, I want that. I want some of that. Then I go find out the professional that really can do a deep dive in that space. And I'll give you a quick example. Like one of our, I recognize that there's opportunity in the renewable energy space partly because of the Inflation Reduction Act, mostly because of the Inflation Reduction Act. So when I go and do something in that space, I'm not going to spend days and months studying, and no, I'm going to find a professional. We have a meeting tomorrow afternoon at with professional solar guys. And, I want to know more about this stuff. It doesn't mean that I'm going to become the expert in that space. I guess my point is, yes, learn about it. Yes, educate yourself, but don't convince yourself that you have to be the professional and know everything about that space. Go learn somebody. It's okay to be it's really for us as business owners and entrepreneurs and investors, we should be the generalist. Like we want to see what's going on, but then go hire the specialist. Go hire the specialist, somebody that's top shelf in his space.
Awesome, Dave. Again, thank you so much for investing in our community. I do want to remind everybody about next month's call. This is going to be on March 13th at 10 a.m. Central Time with Mary Hart, talking about how to live out your legacy today, but then also how to pass on wealth and how to pass this stuff on, because you don't want your kids to have to mess with this either, or you want to educate them today on how to make that happen. So make sure you guys tell your friends about us. This call was recorded. It will be on our website. It will be on all of our social media platforms as well. So if you guys are interested in rewatching this, which I think some of you guys might, or if you want to send this to one of your friends, I highly recommend that. Also, don't forget about the videos we have for the last real estate free-for-all event. And then make sure you guys get signed up for this year, September 7 through 9. We've already got people signed up. We have a great VIP package this year. You guys want to make sure you take advantage of for that. And don't forget, I did get $250 already from this call. Thank you, Brandon Rooks, for that. But if you guys are interested in helping me with these kids trying to get to Costa Rica, I'm trying to raise a little bit more money for that. Let me know. You guys can text me, email me, or however else you want to get a hold of me. Facebook message me, whatever. It's been a pleasure, everybody. Happy Valentine's Day. Go kiss your sweetie. Make sure you let them know you love them. And thanks again, Dave, for investing in our community.
Thanks, Tom, and thanks to everybody on the call. Happy
Remember,
Valentine's Day.
be a conduit, not a bucket, guys. Have a good week.